Hello, and welcome to the Milken Institute's 2020 Global Conference session on the transformation of U.S. equity markets. My name is Mike Piwowar, and I have the pleasure of moderating our discussion with an all-star lineup of panelists. Our first distinguished panelist is Dan Gallagher, Chief Legal Officer at Robinhood, a pioneer of commission-free investing. Dan's previously served as Commissioner at the U.S. Securities and Exchange Commission and held several other positions on SEC staff prior to that appointment. Next, I'm pleased to welcome Melissa Hinmon, Director of Equity Trading at Glenmede Investment Management, an independently owned asset management firm. Melissa holds many leadership positions on a number of industry boards and advisory committees. I'm also delighted to welcome Jamil Nazarali, Global Head of Business Development at Citadel Securities. Jamil also serves on a number of industry boards and was a key member of the SEC's Equity Market Structure Advisory Committee. And last but certainly not least is Chester Spatt, a Pamela R. Dunn and Kenneth B. Dunn Professor of Management at the Tepper School of Business at Carnegie Mellon University and is a Milken Institute Senior Fellow. Professor Spatt is an internationally renowned expert on equity and bond market microstructure, and he previously served as Chief Economist at the SEC. We're so fortunate that all of you could join us for this important topic. While the five of us could certainly fill the next hour and longer, we will leave time for questions from the audience. So those of you watching on your devices, please submit questions online at any time during our session. Now, to set the stage for our discussion and keeping in mind that today's audience is a more general audience than maybe market structure experts, I want to clarify from the outset a couple of terms that we're going to be using throughout the session quite a bit: retail and institutional, and from the outset. So retail investors are individual investors. They are non-professionals who invest their savings in equities and other financial assets. They make their trades, their purchases and sales through brokerage firms or investment advisors, and their trade sizes tend to be small. Institutional investors, in contrast, are professional investors who trade larger sizes on behalf of members or shareholders. And of course, some of these shareholders could also be retail investors. Examples include mutual funds, exchange-traded funds, hedge funds, pension funds, insurance companies, etc. So with that, let's get on with this discussion. So let me open this our discussion with a question. Let me ask Jamil first, and then go to Melissa. As we know, one of the parts of the Securities and Exchange Commission's regulatory mission is to maintain fair, orderly, and efficient markets. So my question to you, Jamil, is how fair, orderly, and efficient are they, and how does this compare with historical trends?
Thank you, Mike. Really appreciate you having me here. The markets are incredibly fair, efficient, and orderly. And I think the experience over the last 6 months demonstrated that in spades. So we had, more than a doubling of volume, very high volatility. We had the closing of trading floors. We had a number of people from the industry forced to work at home. And yet the market missed a beat. And if you contrast that, you asked how does that compare to times past? If you compare that to Hurricane Sandy, when the New York Stock Exchange floor closed, the market had to close. It was unable to open with one of the major trading floors closed. I think we've come a long way since then. And if you contrast that to other asset classes that didn't function nearly as well as the equity markets, for example, some of the fixed income markets during this period of extraordinary volume and volatility, or if you even compare that to places in other parts of the world where either there's not an abundance of competition, so there's a primary market, and when that primary market goes down, people can't trade, or even what we saw earlier this week in Europe, where there's a number of different markets, but they're not knit together in the same way that we are in the U.S., so that when Euronext went down, basically all trading stopped in French stocks. That's very different than in the U.S., where if one of the major exchanges went down, likely people wouldn't even notice. So I think that the U.S. markets are the envy of the world for a very good reason.
Melissa, let me get your perspective on this. Are you as positive about the orderliness and efficiency of the U.S. markets as Jamil is?
Oh, absolutely. Actually, Jamil kind of hit everything that you could possibly think of in that response. From where I sit and from our experience for our clients, like Jamil said, over the past 6 months, 7 months, we've had extraordinary circumstances. And given the robustness of our markets, they are incredibly efficient. We've had absolutely no issues trading, executing any orders whatsoever. It really is a testament to all the exchanges and the coordination there and the SEC, as well as DMMs like Citadel, who have invested heavily in their own technology to make sure the markets maintain a sense of normalcy and are extremely robust, that they will, in the most extreme cases, function extremely efficiently. And they did. It was amazing.
Yeah, Dan, let me get your perspective on this, and I'd love to get it particularly on the fairness of the markets. You know, when you and I both served the Securities and Exchange Commission, we got lots of questions related to the Michael Lewis Flashboy book, which seemed to suggest that the markets were rigged against retail investors. You're now the chief legal officer of an innovative firm that is empowering retail investors. From your perspective, how fair are the markets for retail?
So first of all, it's great to be here and to be sitting on a panel with you again, Mike. It's been too long since we've at least virtually been sitting next to each other. Look, I echo the sentiment that you just heard, that the markets are as fair now as they've ever been, and it's a great atmosphere for retail investors. As you said, when we were sitting on the commission and Flash Boys came out, there was a lot of consternation, a lot of introspection, a lot of congressional scrutiny within our building at the SEC about, are the markets rigged? And I think, Mike, you very vocally, myself and Chair White at the time, were pretty public in saying, we think that the markets are actually really fair. And think about it now, Mike, I think that's 7-8 years ago that book came out, and things have only gotten better since then. I'd like to take a little credit on behalf of Robinhood. I think as a market disruptor coming in on behalf of individual investors and our customers, and getting rid of commissions, which is a feature of retail brokerage for decades, and getting rid of that fee class and sending billions of dollars back into the pockets of investors everywhere. I think it's really a great time to be a retail investor. And then relatedly, you've seen initiatives at the commission to further improve and enhance transparency on order handling and best execution and other things. And I think both sides, the market forces as well as the regulators, have been doing a great job to ensure that we continue to maintain and actually enhance the atmosphere for retail investors.
Chester, you've studied markets for years, and you've studied them through a number of different regulatory and technological changes. You've done empirical studies in terms of the metrics involved in measuring things like liquidity and execution quality and other important measures. How would you characterize the markets today?
Well, first, I want to thank you for the invitation to participate on today's panel. I would characterize the equity markets, like my fellow panelists, as very fair. I think it's been a very good environment for retail investors. A few of the metrics that I would point to in which the markets have changed over a long period of time have been much finer tick size. So now trading, of course, is in pennies, as opposed to in earlier eras, eighths and sixteenths. This has resulted in lower spreads to investors. And I think also some of the regulatory changes over time have led to much greater competition in the intermediation activities, which have also greatly tightened the spreads that investors experience. I think spreads are a very important indicator, at least for the retail investor, of the quality of their execution. One other example I would point to from recent events was actually the temporary need to close the floor of the New York Stock Exchange due to the COVID. And I think preliminary indications are that order execution quality didn't go down. In fact, there's some academic evidence to suggest that perhaps at the close, market quality may have even been enhanced further because of a greater leveling of the playing field. So I think all the indications are that our markets continue to function very, very well.
Okay, so there's widespread agreement that our markets in the U.S. equity markets are functioning very, very well, but that doesn't mean that there's not need for improvement, right? We're always looking to improve our markets. We're competing against other capital markets around the world. So, Melissa, let me start with you. What could be improved in our markets, either for institutional investors or for retail investors?
Well, starting from the institutional side, I think this is probably going to lead into a conversation that we had that will carry us forward on our prep call. From an institutional side, I think that we could have a little more transparency. Granted, we have new order handling rules that are rolling out that are should be very helpful. That's 606B3. I don't think we're going to talk about that today, but I also believe that to some extent, and this goes back to Chester kind of hit the nail on the head when he said the narrower spreads have helped, at least on the retail front. Narrow spreads really aren't something that's that important to institutional because of the size of the orders that we have, and it's the supply and demand. Very seldom would you buy on the bid or even buy on the offer, or vice versa. For me, I think what could be improved on that front would be a little more transparency with orders that volume and trades off exchange that we don't have access to. And that's really to a deeper conversation, I think, later on in this panel. But that's the one thing I think from where I sit that we really need some robust improvement. And going back to competition is great for markets, but even going back to Reg ATS, regulation, alternate trading system for people who aren't in our industry, in 2005, I think the commission recognized how important that competition is to our industry. However, I don't think that they had intended the unintended consequences of the amount of stock that trades off the exchanges that we don't necessarily have access to as institutional investors and or retail investors. So for me, that's a sticky wicket all the time.
All right, thanks. So Jamil and Chester, I mentioned Jamil was on our Equity Market Structure Advisory Committee. Chester was also on that committee in addition to some of the other things he did. The fact that we had an advisory committee at the SEC suggests that there are things that could be improved. Jamil, let me start with you. In terms of where you sit, what do you think are the biggest things that could be improved?
So, I think that there's minor improvements that we can make. For example, synchronizing the circuit breakers between the futures and equity markets. There were a few things we learned over the period of volatility that we can improve. I think the bigger risk is that we not put in place changes that actually roll back many of the improvements that investors have received. So right now, one of the strengths of the marketplace is that when you see a bid, it's real. We all know decades ago there were a lot of bids out there that weren't real, and that there's coordination of putting up bids, and so we need to make sure that those things are not rolled back. One of the things that some business models are pushing is an asymmetric speed bump, so that a market maker could post a quote, and if market conditions change, they could remove that quote before someone hits them, right? This is the same thing that we have in the FX market, which is last look. And that market is moving to eliminate last look. There are some business models that say, hey, wouldn't this be great? We can provide more liquidity. So I think I'd like to answer your question in the converse, that we need to be very, very vigilant not to roll back all of the gains that investors have made, and not to put in place things in the name of innovation that actually end up hurting investors.
Yeah, so Chester, so Jamil is suggesting more of an incremental approach, sort of around the edges. Would you agree with that, or do you think that there are big structural changes that need to get made?
Well, I would. I fundamentally I agree with an incremental approach, but I'm not. But I think that there are some changes that would be desirable in our markets, we have this. I think the markets are functioning extremely well, but we have this very complex structure of fees and rebates, that I think makes it very difficult for many institutional investors, and I'm not sure, obviously, advantaging retail investors. So I think there's a dimension in which I think there's scope for considerable improvement, perhaps even eliminating the structure of fees and rebates. I think it's a little bit of an anomaly within that structure, and I think also issues associated with market data, and whose data is it, and to what extent best data is monopolized. I think these are also potentially important issues, at least for institutional investors. And so I think I would be inclined in this space to focus on the needs and preferences of institutional investors, especially to the extent that they don't conflict with the preferences of retail investors.
To ask a question about retail participation, we've seen a huge increase this year compared to years past. How big of an increase is it, and what's driving it?
Well, so it's a great question, and it's an even better phenomenon, Mike. There is a huge surge in retail participation in the U.S. capital markets, specifically the equities and options markets this year. Some folks attribute it to coronavirus. There's no doubt that played into it a bit. At Robinhood, we're obviously thrilled to be, part of this new wave of retail participation. I think, Mike, I don't know how many speeches you gave, but I gave several as a commissioner decrying the loss of retail investor participation in our markets. And we had seen as commissioners some disturbing trends away from really traditionally high levels of retail participation in America. It's a hallmark of American capital markets. We have such strong retail participation, but that had been waning since the 80s. And at the same time, we saw the rise of passive investing, right? So mutual funds and index funds that encourage passive investing, which has been another, I think, terrific phenomenon for the markets. But at the same time, you've heard a lot of criticism of the rise of passive investing, where retail investors are not as engaged as they used to be. They're not the owners of the underlying companies directly. They're not voting and monitoring and paying attention to their investments in issuers. And so I think, as a policymaker, this is an amazingly positive trend for the capital markets. We've seen metrics at Robinhood, Mike, this year that are indicative of this rise. In the first 4 months of this year, we added 3 million funded accounts to Robinhood. And so I can safely say here that we have 13 million approved accounts at Robinhood. And so just huge numbers of investors coming in. And I have to tell you, it couldn't happen at a better time, right? It's just sort of demographically in the country, we have this phenomenon, this transition whereby the baby boom generation, who's been accreting assets, including securities over the years, are now in retirement age, are divesting, selling out of their 401ks and IRAs. And it's actually pretty important for the markets that we have a new wave of investors coming in, to participate, to take up that slack. And again, at Robinhood, we're thrilled because we believe we've reached out and connected with a constituency of investor in America that previously just hadn't been served, that hadn't been paid attention to. And by offering commission-free trading, no minimum account balances, by offering tons of good educational resources that we push through our app and make available, and that our customers love. We've seen a huge uptick this year in our customers accessing our educational materials. We're happy to be part of this phenomenon.
Yeah, so Dan, so related to that, we've had a couple questions come in from the audience around the common theme of worried about retail investor sophistication, right? Is it too much a momentum? Are they driven by more by emotion and name recognition rather than traditional valuations? Is there a bubble? You know, those sorts of questions, right? And you mentioned the education and training materials, right? The SEC and FINRA and a number of government agencies have done a number of things to try to educate investors and have, you know, no way of knowing whether anybody's accessing these. You mentioned that you have these materials and you've seen a level of engagement there. Can you talk about that?
Yeah. So look, I think first and foremost, the best type of education is being in the game, right? So having access to the markets, being able to buy and sell stocks and paying attention in individual stocks. So that's a really powerful tool. And again, I think, you know, at Robinhood, we're happy that, you know, we've tapped into this new generation of investors. We've gone mobile first, right? So we're not a clunky web-based system translated into an app. It was app first, and that's how this new generation wants to communicate, wants to participate in the markets, not just the securities markets, but more broadly. But with that, Mike, comes big responsibility, and we fully understand that at Robinhood, that we need to not only just hand over the tools to the investors, but we need to help them as best we can make the right decisions. So we're self-directed brokerage. We don't make recommendations to folks, but we're intently focused on providing valuable educational materials to folks so that they can make the best decisions. The metrics there, kind of like the growth in our account base this year, are really important. We have an education center we call the Learn page, which has 650 or more unique articles, educational articles that our customers can access. And we've seen a 250% increase in access to that Learn page throughout this year. We also try to do things, we say, in the Robinhood way. We want to help educate our customers in a way that they want to be educated. So we do some non-traditional things, Mike. I don't know if you've seen our Robinhood Snacks offering, where we have a podcast with 2 million plus subscribers and a newsletter called Robinhood Snacks with 20 million plus subscribers, where the guys who run that talk about market issues every day and give color to sort of M&A transactions and other market trends. And it's hugely popular and at the same time hugely educational. But we're not done. We're working hard. We've made a public announcement specifically with respect to options. We hired a new options education specialist recently. We're trying every day to provide new and better resources to our customers so they make the right decisions.
Yeah, so Chester, so Dan mentioned, companies like Robinhood are not done. The SEC is not done in this space either. In addition to maintaining fair, orderly, and efficient markets, one of the other parts of the mission of the SEC is to protect investors. And we had an interesting case study earlier this year involving Hertz, a company that was in bankruptcy, wanted to sell, I believe it was $500 million worth of stock. And the Securities and Exchange Commission and Chairman Clayton in particular became concerned over the disclosures there. Can you talk a little bit about this case study and the role of the SEC in this space?
Yeah, I think the SEC played a very important role in this example. The bankruptcy judge supervising the Hertz case is an interesting example in corporate finance. The bonds of Hertz after the bankruptcy filing were selling at about 40 cents on the dollar. That's because basically the capital market doesn't think they're going to get paid very much. And our bankruptcy law basically uses a system of absolute priority. So basically, before the equity holders get money, or get much money at least, the equity holders, the bondholders need to be paid. So basically, the implied value based upon the bonds of the equity is negligible. But the equity for Hertz was still selling at a several dollars a share, and then the Hertz attorneys got a little too clever, they went to the bankruptcy judge and said, "Can we do an offering of the old equity?" In effect, this would provide more money to pay off the bondholders. The bankruptcy judge said, "Sure, go ahead." And Chairman Clayton, in an interview on one of the financial networks, was asked about Hertz and was it really appropriate for Hertz to be issuing equity? And Chairman Clayton raised concerns about the quality of the disclosure that was being provided. Even though I thought many observers thought, okay, they were kind of disclosing that people were unlikely to get paid. But Chairman Clayton really kind of joined the issue in the public arena, and within a few hours, the SEC staff met with Hertz at Hertz's request, and within a day or two, Hertz pulled the offering. I think because they recognized that they were going to be in a heap of trouble with the SEC if they push forward on basically selling worthless securities to retail investors. So I think this was really a great example of investor protection by the SEC.
Yeah, thanks, Chester. Jamil, you at the outset you mentioned all of the volatility and the large amount of volume in March of this year, and the fact that all happened at the same time. The New York Stock Exchange closed its floor, moved to fully electronic trading, and a lot of folks went to work from home. And in fact, we all learned a new acronym, WFH. For most of us, it meant work from home. But at Citadel, it meant work from hotel. So tell us about how Citadel was able to weather the storm in terms of working from elsewhere.
Sure. Thanks, Mike. As you know, Citadel trades roughly 1/4 of all U.S. equity volume and handles roughly 40% of all retail volume. And we take our obligations to provide. We take our responsibilities very seriously. And so very early on in this pandemic, we thought it would be appropriate to make sure that no matter what happened, remember at that time there were companies shutting down. You couldn't work from home. There were even bandwidth issues from working at home because so many people were logged in. School kids were home and they were doing school from home. And so we wanted to make sure that we would be able to provide liquidity no matter what the conditions were. At the same time, there's an opportunity because there were a lot of hotels that were completely empty and they didn't have anyone staying there. And so we found a hotel in Palm Beach. We were able to sign an agreement with them that would allow our people to go down there. And then over the 10 days between when we signed the agreement and when we started trading, we had over 100 people working around the clock to install miles of fiber optic cable, connectivity, build a trading floor. And we created an ecosystem where everyone that was in that ecosystem had to be quarantined, tested twice. And so we were able to move employees and their families to be able to trade and provide liquidity to the markets. And it was a great backup facility for us and continues to be, so that if we see a second wave, we have a venue where we can get people and we can ensure that we can contribute liquidity to the markets. By the way, it was also a great venue for us to bring our summer interns down. One of the really important programs for us in bringing on new people and important for many students is being able to get to know a firm. And that's really hard to do when you're doing an internship from home. But we were able to bring these people into Palm Beach and have a relatively normal summer internships where they could interact with their teams, they could be on the trading floor, they could go out to dinner and get to know their colleagues in non-work sessions. So we thought that was a really big success for us and for the markets.
Yeah, that was very creative, and from what you said, very, very successful. Melissa, let me go to you in terms of what we refer to in the industry is business continuity plans, right? So what if something bad happens? And every time something bad and different happens, firms go through looking through their business continuity plans, right? So we had September 11th, for example, and we learned from that, and firms went back and redid their business continuity plans. Then we had Superstorm Sandy was another one where firms had to go back and do that. And now with COVID-19, what did we learn from this crisis or what did your firm learn from this one that you're now going to take into account?
Well, it's pretty interesting because I've been with my firm for 5.5 years, and we actually had a very robust BCP plan in place. And as a matter of fact, one day I came to work to find out that I was in the pandemic group. I had no idea that I had never had this testing before. So my firm is a smaller firm. We employ about 440 people. And we had such a robust plan in place that it was pretty seamless for us. We didn't have to be as creative as Citadel did. I commend them. That was absolutely fantastic. They did a great job helping the markets maintain the integrity and the robustness that we needed to do our job for our clients. So thank you, Jamil, and I know that you have a heavy hand in that. But we work around the clock still. We have regional offices that we have to keep in check, as well as our mothership in Philadelphia. But I think that one thing that we've learned, surprisingly, is that we can work from home pretty seamlessly. I do agree with Jamil that the summer internship was a bit of a hurdle. We didn't have the ability to bring them in the office, or meet constituents and people they'd work with, or other people that they were in a group with, which is unfortunate because I think that those students missed out on a big opportunity there. But I think our HR department worked very, very hard to try to do one-on-one sessions, whether it was through WebEx, lunches, we have presentations. So I think that all in all, we learned that we can work from home seamlessly, but we do miss the environment of being able to deal with our colleagues and especially interface with our clients in a unique fashion. Bringing our retail clients in from our high net worth side of the business was a little bit different in that, some of them hadn't been that familiar with some of the WebEx and Zoom or whatever we needed to use for that meeting. So I think a little education on that front goes a long way. But again, pretty seamless. So we've been pretty happy.
Dan, every time we see market volatility, in particular markets going down, there are calls to do two things. One is to close the markets, and the other is to ban short sales. In the global financial crisis, regulators were able to stave off closing the markets, but under political pressure, the chairman at the time was forced to ban short selling in financial stocks, and it had detrimental effects. Can you talk a little bit about the importance of keeping markets open and how that was actually a success story for the U.S. equity markets and why banning short sales is a bad idea?
Yeah. So look, Mike, you hit the nail on the head. History is destined to repeat itself, right? If you don't learn from it. And I applaud the commission because they learned from the bad lessons of 2008, specifically when it comes to the short selling bans. Having lived through that in the Division of Trading and Markets at the SEC during the time, I don't second guess any decisions that were made. I can tell you the pressure coming down on Chairman Cox at the time was coming from the very, very, very highest levels of the government, and no mere mortal is going to resist some of that pressure. We had two waves of short sale bans, one focused on financials in the summer of 2008, and then we had a broader, purportedly financial focus, but it really a long list of issuers covered by a later ban. And in some ways, Mike, it was the best thing. I know I'm preaching to the Mike Piwowar and Chester Spatt choir here because PhD economists love data, and those failed experiments created data and showed that the bans created distortions in the markets and actually stopped the healing process of the market. So Jay Clayton and the commission, Brett Redfern and the staff in trading and markets at the SEC saw those lessons, looked at the great work that the economists had done to analyze that data, and realized that the calls for more short sale bans were the wrong ones. And the calls to close the market, I don't think they ever had any real traction at the commission. And I'm glad that they didn't. And I'm glad and pretty proud to watch as Jay Clayton went on publicly on TV and said that he just simply wasn't going to do it. Even when you had so-called market experts, big market participants screaming from the highest mountain to do it, they realized that would be pure folly, and they didn't do it. So a really good call.
Yeah, Chester, let me follow up with you on that. In addition to not banning short sales, the SEC kept the markets open. Why was it so important to keep the markets open rather than just closing it and taking a week-long timeout, let's say?
So first let me associate myself with Dan's terrific remarks. This was different than a Hurricane Sandy or a 9/11, where infrastructure issues potentially would have undercut the operation of the markets. Here, a closure, or even more moderately, a ban on short sales, would have been a statement to market participants that things are even worse than you think. However bad you think they are, they're even worse. And I think that would have been terrible for the markets. Markets have to find their valuation, maybe even with help from the authorities. And certainly, the Federal Reserve was very active in some of this period by their actions on March 23rd and April 9th. But to say to the markets, the news is so bad that we're not going to allow trading and we're not going to allow valuation to be found. This would have been terrible for the markets, and I think the leadership of the commission showed great fortitude. And I think one commonality in 2008, in the face of a lot of pressures, and even to a modest degree, pressures even from the Treasury, which is a little less oriented toward the markets.
Yeah, Jamil and Melissa, in contrast to completely closing the markets, it's generally agreed that, in times of, large order imbalances or sort of liquidity pockets, there should be temporary trading halts. And so after the 1987 stock market crash, market-wide circuit breakers were put in. After other periods of volatility, the SEC has experimented with single stock circuit breakers and something called limit up, limit down, which is pausing trading and allowing liquidity to come back into the markets. Jamil, let me start with you. How did those perform during the COVID-19 crisis, and is there any lessons learned from those?
Sure. They performed actually fairly well. I mean, there were some tweaks and improvements that we can make. For example, I mentioned earlier synchronizing the futures and cash markets. There were also some tweaks around, when some of them triggered on a stock open, where you really didn't need that pause because the stock just opened. So there were a few tweaks, but generally they worked quite well. In the U.S., we talked earlier, and again, I agree with the comments said and commend the SEC for not bowing to pressure. There were short sale bans implemented in other countries over this time, and we got a new, fresh set of data for many academics to look at, and everything that we saw in previous short sale bans was confirmed. So in markets where short sale bans were implemented, spreads widened, volatility actually went up, liquidity went down, and so it costs investors a lot of money. Unfortunately, I think this is one of these things where we in the U.S. have learned from the lessons of history, but many other countries have not.
Yeah, no, and that speaks to Chester and Dan's point about the academic evidence and the empirical evidence in market structure issues. That, at the SEC, sometimes some of the issues can be kind of fall down on political lines, but market structure is one of those areas where facts on the ground, empirical evidence, really seems to matter. Melissa, let me get your perspective on the circuit breakers and the single stock limit up, limit downs. Work as intended, as Jamil said, that there works pretty well, but maybe some tweaks. Do you agree with that?
I 100% agree, and I do agree with aligning the cash and the futures. For us on the single stock limit up, limit down, one thing we did do was kind of buffered some of our, like Jamil said, some stocks didn't need to halt because they had just opened. In that instance, what we were doing is we were kind of taking a step back in the first 10 minutes of the day, letting things settle out, see how they went in the event that limit up, limit down didn't work the way it was intended. But for all intensive purposes, there's a lot of work that went into limit up and limit down. I know some very smart people on the committee. The SEC's worked hard on getting this right, and I was very happy, I think, as well as our clients and my trading team, and how well the markets performed.
Yeah. So, Jamil, let me go back to you now. In addition to closing the markets and short sale bans when volatility comes up, right? Another bad idea that never seems to go away is imposing a financial transaction tax in the U.S. It's one of these things where it's been imposed in a number of different jurisdictions throughout the world. It never works as intended. Can you? And you talked about learning from others from the short sale ban, right? What can we learn from other jurisdictions on why a financial transaction tax would be bad?
So I think we can learn a couple things. Number one is that markets are very portable, right? And so we saw in Sweden when financial transaction taxes were imposed, a lot of the volume moved to London, and it decimated the Swedish markets, right? And a lot of jobs were lost, and the revenue that they raised was much less than they anticipated. In fact, they ended up not only withdrawing the financial transaction tax, but right now they are one of the biggest opponents in Europe of implementing a financial transaction tax because they know of the damage. So number one, it doesn't raise the revenue that's anticipated. Number two, it sounds appealing to some segments of the population because it's a tax on finance, right? And everyone loves to hate finance. But the reality is the financial transaction tax is passed on to end investors. And so it becomes a tax on savings. It becomes a tax on retirement. And it becomes a tax on the little guy because it gets passed on. And, unfortunately, we're seeing this right now in New Jersey, where the state of New Jersey is considering implementing what they call a data center tax for those in the financial industry that have their data centers in New Jersey. If implemented, and we've all tested our backup facilities, the industry is going to move. So not only will the state of New Jersey not collect a single cent in the taxes, but they'll also lose hundreds, if not thousands, of jobs and hundreds of millions of dollars of investment because the data centers will move, all the jobs will move, there'll be no expansion of that, and none of the tax will be collected. So it's, as you said, a really bad idea.
Yeah, Melissa, so do you agree with that? I mean, firms, will move very quickly out of New Jersey and they won't get the tax revenues and they'll lose the jobs. Anything else to add to that?
No, it's right. And Jamil, I think on the heels of that, I believe SIFMA submitted a letter this week, and they said something like 38,000 people are employed in the financial industry in New Jersey alone, and about 55,000 people actually benefit indirectly, whether it's through job creation and or inducements in New Jersey. So outside of the revenue that they've lost, they'll lose a significant portion of their jobs. But as far as the individual investor goes, people keep saying, "Oh, it's just such a small tax. It's de minimis." But it's really not. If you have somebody that's participating in a 401k or a 529 or even an IRA, or where they put money in on a regular basis, they're getting hit every time they enter a transaction in the marketplace. It's eating into their cost of their return, right? So in the end, I agree with Jamil. I saw that Chester was nodding earlier. And also, and I want to bring up, Dan, not to push it over to you, but you have had a very diverse investor base this year with Robinhood. And I think that would dramatically impact your investor base. So I think it's negative all around. I don't think they're going to, I agree with Jamil, they're not going to raise the revenue that they anticipate raising. And at the end, even though it's gone through several modifications, it did come through initially as a data tax, as Jamil mentioned, but it also included MasterCard and Visa, who had, but they stripped that out, left it with the financial industry. And again, I guess the New Jersey Assembly Monday modified what they were looking for yet again. And I hope it doesn't pass. But the other thing that scares me is if New Jersey does pass something along those lines, this could be a litmus test for other states to do the similar thing. And then we have a whole different ballgame.
Dan, yeah, let's pass it over to you. How would your investors be impacted, your clients be impacted by this?
Yeah, Mike, I don't think I could say it better than Melissa and Jamil did. At the end of the day, everything trickles down, right? And within our markets, we talk about institutions and issues in the institutional markets, but the institutions serve individuals, right? And so at the end of the day, the impact of this is going to be on the everyday American. The liquidity is going to dry up. The fees are going to erode long-term performance in the equities markets and elsewhere. And to Melissa's point, we at Robinhood, we've been thrilled to be rolling out new products that our customers tell us they want, right? They wanted fractional shares. They wanted dividend reinvestment. They want recurring investments. That's one of our newer ones where you just set it up, every month, every week, whatever the regularity is, to invest in certain assets over time. And the financial transactions tax, to Melissa's point, is antithetical to those products. And again, we're not just sitting around, cooking up these products and rolling them out. We're talking to our customers and asking them what they want. And when we roll it out, we get this massive uptake. And then you see the specter of a financial transaction tax looming over that. And I just think from a policy perspective, it's the exact opposite of what folks should want.
Yeah, and Chester, let me get the economic perspective, right? We've heard that, there's changes in behavior. Where a tax is levied is not necessarily where it's born. What other lessons from the lens of economics can we learn about the effects of a financial transaction tax?
Well, I think the broad lesson is the one that Jamil highlighted, which is that markets are portable and mobile, and you cannot tax very hard goods that are elastic. That's the central lesson in optimal tax theory. I mean, one thing I think in the New Jersey context, by the way, that's interesting is my understanding is that the proposed New Jersey budget doesn't include revenue from this, and there's two interpretations of that. One, because I think the political elites kind of realize that this is just for show at this point. They kind of realize they're not going to be able to pull it off. And I think two, they recognize that if they do impose it, that the business will simply move. In fact, in some ways, I have to say, as an academic, I almost hope they do this. And the reason I hope that is because this will be such a clean example of how the political class gets it wrong with respect to the import of taxes.
Thank you, Chester. I never thought I would laugh during a market structure panel, but that was great. Let me. I think we've got time for at least one more round of questions here. So the theme of this year's global conference is meeting the moment, and it has a number of different meanings within finance, and a number of the finance panels that we've had have focused on a couple key themes along that. One is providing access to capital, whether it's financial capital or human capital, to underserved communities, highlighted by some of the social justice issues that have come to the forefront most recently. And the other is highlighting that although there have been some efforts that have led to success in improving diversity, equity, and inclusion within the financial industry. There's still more yet to go. Dan, let me start with you on the first part. Right, we saw that overall there's greater retail participation in the stock market. That's a good thing. We've also seen historically that certain minorities have been underrepresented or underinvested in the stock market, and that's unfortunately, exacerbated wealth inequality. Any new statistics that's either you're good, bad, or indifferent on that front?
Yeah. So, Mike, this is a huge issue, right? And the financial services industry, I think, is doing some good work and needs to do better work in this space. At Robinhood, we were founded because our founders believed deeply that the financial markets weren't working for certain Americans, right? That there had been no attention paid to a really important constituency of potential investors. And so, to your question about statistics, we were delighted at Robinhood recently to see a new Yahoo Finance Harris poll come out, and it came out with statistics on the increase of retail participation by diverse investors, right? Bridging the gap between non-diverse and diverse investors that has existed for far too long.
So let me go to you, right, on the issues of diversity, equity, and inclusion, right? So you came into the industry years ago. The security trading industry is very much a male-dominated industry. Talk about some of the experiences you had, and now you've become a leader in a number of efforts through the Security Traders Association and a number of other boards that you're on, improving female and minority representation in this industry.
Well, I've been in business 34 years. Thank you for not saying how many years. It was at the time there were very few females. There still are very few females. And as far as the diversity of color, I think that's even worse than the lack of females in the industry. I know I'm very proud to work for a firm that herald half of our senior leadership, actually more than half, is female. Diversity is on our forefront of everything that we do. However, and I know there are other brokers, asset managers in the industry that also do that. I think in order to make things right, we have to actually start, and this will feed into Chester, I'm sorry to say, but Chester, I don't mean to put you on the spot. We actually have to start with some kind of getting a spark for younger people, allowing them to be included and understanding finance at a very early age. I work with a couple different groups that serve communities. I'm in the board of the National Organization of Investment Professionals, and we have actually contributed to RISE in New York City, which is all about financial robustness in underserved areas. Things like that. Education, we start with education first, because without getting people interested in the industry and actually fostering that spark that we initiated in them and carrying them through college, it's almost impossible to maintain that.
So, Jamil, can you tell us about what Citadel is doing in the areas of diversity, equity, and inclusion?
Yeah, we are doing a much more comprehensive job of diversity and inclusion, and have developed a working group on which I'm on. But I would say diversity and inclusion fits very well with Citadel's culture, because we have a very strong culture of meritocracy, and it really depends on kind of how you define diversity or inclusion. So, for example, if you look at our workforce, more than or almost half of our workforce is typically white male, which you find out on Wall Street, and a big part of that is because we are a very strong meritocracy. And so, if someone exhibits strong ability, they get the job, they get promoted, and our CEO is Chinese-born American. He's very young. He rose to that position very early in his career. But we also recognize that we need to do more, and so we're taking a look at our recruiting practices. We're taking a look at our engagement in the community, and we're taking a look at kind of the opportunities we give to people. So I think that I'm really proud of the job that we've done, driven by our meritocratic culture, but we also recognize that there's more that we can do, and we're actively engaged in figuring that out.
I want to thank all of our guests. Unfortunately, we've lost Dan Gallagher, so he's not here to hear my thank you. Jamil and Melissa and Chester, thank you all for an engaging discussion on a wide range of topics about the U.S. equity market and all the implications for things like closing the markets and short sell bans and financial transaction taxes and all the work that you're doing on diversity, equity, and inclusion. So thank you all very much on behalf of everyone at the Milken Institute, and goodbye to everyone.
Thank you for the opportunity.
Thank you for organizing the panel.